Dividend growth investing is the best way to invest for most people, in my opinion. This way, you can invest in stocks, you can benefit from the stock appreciation, benefit from the dividend and the dividend growth, and also benefit from reinvesting those dividends. So, buying more shares without work. Passive income is the name of the game, and dividend growth is the way to build the most passive income for your future. So, in this video, I'm going to go over my top 5 picks for dividend growth stocks. So let's get right into it. Now, first, I want to go over a few things to explain my philosophy on how I pick dividend stocks and the things I look for. So we're going to go over a few things, and then I'm going to get right into my top 5 picks. So let's get right into it. My top 5 dividend growth stocks. Now, why do we want to invest in dividends? Since 1960, 85% of the cumulative return of the S&P 500 are attributed to the reinvested dividends. This is a study performed every year by the Hartford Funds. Now, many people don't believe this. This is kind of a astounding number. You mean to tell me 85% is due to dividends? Not just receiving dividends, but receiving those dividends over a long period of time and reinvesting those dividends, compounding your return over and over and over, and accelerating the compounding at that. So check this out. This is a chart that says if you were to invest $10,000 in the S&P 500 in 1960, in 2024, you would have $982,000. That's just the stock price. That's not including the income and the reinvestment of dividends. But if you were to receive and reinvest your dividends, you wouldn't have $982,000. You have $6.3 million. That's from $10,000 invested from 1960 all the way to 2024. That is the power of dividends, and this is why knowing how to dividend invest and having a dividend growth portfolio and reinvesting those dividends are very important to building wealth. So let's get into your thing. Okay. When you are investing in dividends, you have to make a differentiation between if you're investing for income or growth. These are two different philosophies. And based on your purpose for investing in these dividends, that could be the deciding factor on to pick a stock for this portfolio or not. So when you are investing for income, you are focused on investing and receiving income now to pay expenses now. So you're typically, are you going to focus on companies with a higher dividend, higher yield, companies that have a safer dividend, because you don't have a lot of time to stop, sell stocks, reinvest in other stocks if something happens with that business, if they cut or stop their dividend. And of course, current income, you're focused on higher dividend yield. You may not pick something with a 0.3% dividend yield if you're looking for income. You're going to look for something at least 3%, maybe up to 5 or 6% yield, because you need income now. So these are going to be your Coca-Colas, your Verizons. These are going to be your REITs, your real estate investment trusts with higher dividend yields. That way you can depend on the income sooner. Now, what I'm talking about is growth dividend investing. So I'm going to be focused on stocks with lower dividend yields and a higher potential for growth. I want stocks that have the potential and the likelihood to continue to grow their dividend over time. And I'm focusing on a higher yield to cost. Now we're going to get into yield to cost so you understand what I'm talking about. So when I say yield to cost, let's go over this example. So yield to cost, you invest in something and we're looking at income of that stock divided by our initial cost. Now here's how to think about yield to cost. When we talk about dividend yield, we typically just think about the current stated dividend yield based on the current price. So if you buy a stock for $100 and you get a $2 dividend, that means that stock has a dividend yield of 2%. That's when you buy the stock right now. But we're talking about buying and holding the stock and benefiting from the dividend growth. So yield to cost. Let's say this dividend grows at 10% for the next 5 years. The stock price is now $200. That means it's growing at 20% per year for those 5 years with a $5 dividend. They've grown that dividend from $2 to $5. If you were to buy that stock at $200 with a $5 dividend, you get 2.5% dividend yield. But since you bought it for $100, your yield to cost is 5% yield to cost. So in just 5 years, you went from 2% to 5%. Think about that and how that can compound over 10 years, 15, 20, 25 years. You can easily have a yield to cost of 15%, 20%, 25%, honestly, if you pick certain stocks that are likely to continue to grow that dividend. So that's the idea behind this strategy. You want to focus on yield to cost. We're not worried about dividend yield. We're not worried about how much they're paying now. We're worried about how much they're growing it now and how likely they are to continue to grow it in the future. So let's go over some characteristics of what I'm looking for when I'm looking for dividend growth stocks. Number one, I'm looking for strong companies in the mature growth or the mature stage of their life cycle. Now, what I mean is, this is the typical simple graph showing the life cycle of a business. We have the startup stage, we get to the growth, mature stage, and the declining stage. Now, this graph represents their sales, and this part represents the time. There's no stated time. A company like a Coca-Cola can be at the mature state, king of the mountain, for decades and decades and decades. So companies can stay into these various ranges for various reasons. Another thing to note, say a company like Amazon, they spawn into new companies. Of course, they sell their stuff online, but they also are getting into Amazon Web Services and streaming and pharmaceuticals and groceries. So they have new business lines that are in the introduction or the growth state, while they have other parts of their business in the mature state. So you have to be mindful when you're investing in the companies what stage of the life cycle they're in. Also, the stage of the industry that they're competing in. So when it comes to dividends, this is important because we want to make sure, if we're going to invest in a company for dividend growth, we want to make sure this company is in this mature growth state up to the mature state. We don't want to invest in declining companies, and we don't want to invest in companies that are in that hyper growth state. Some companies might start paying a dividend when they're still in this state because they have so much confidence about their future cash flows, but it may not make the most sense. So you want to be careful to make sure companies are established, strong, and in this range if you're going to invest in those companies for dividend growth specifically. So we want to focus on that. Next, I want a company with a singular focus. Why is that? Like Amazon does not pay a dividend, and they shouldn't. Google doesn't pay a dividend, and they shouldn't. Those types of businesses are going to continue to earn cash flow and use that cash flow to reinvest into their current business and to research and development and acquisitions of other businesses. That's their business model. They're successful at it. I don't see a reason for them to stop. So they're not going to pay a dividend, and it's smart for them not to do that. But that's not a good candidate for dividend growth specifically. We want companies that are paying a dividend and growing it so that when we get to that retirement age, or maybe we're thinking about retiring early and we want dividend income to live off of. So that's what we're focusing on. We're not saying we don't want stock appreciation, stocks to grow, but that's not our main focus. Our main focus is income in the future. So I want a company that's doing one thing, they're dominant in that one thing, very strong competitive advantage, and they're not the type of company to take free cash flow and put it into new businesses and new ventures and acquisitions. That's not what they do. I want them to be interested in paying me a dividend versus reinvesting into the company for new ventures. So I want a company with a singular focus. So strong, mature companies in that mature stage or mature growth stage with a singular focus. Also, I want a company that has a above average dividend growth. So when I say above average dividend growth, the S&P 500 stocks, their average dividend growth is about 5.6% a year. This is over the past 30 years. This is the average dividend growth rate. This dividend growth rate should keep you above inflation, but this is the average for S&P 500 companies. I want them to be above this average for at least that 3 to 10 year range. Now, why this 3 to 10 year range? So now we know companies that grow their stocks consistently for 25 years are those dividend aristocrats. So how is a company going to continue to pay you a dividend, raise that dividend well above average for over 25 years? Or if they've been raising it for 25 years, that they'll continue to do that in the long run if they're in that stage. It's not particularly the case. So this company may be a dividend aristocrat. They might be paying a dividend and growing it over the past 25 years, but maybe they haven't been growing it a lot. And they're in a state now where they can start growing it faster. So I want a company, not just a company paying a dividend for the past 3 to 10 years, but growing that dividend above average for the past 3 to 10 years. So one of the ones that I'm going to pick is definitely a few of those ones are actually dividend aristocrats, but they're in the state now where they've been aggressively growing their dividend because of the type of company and the stage that they're in. So that's very important. Number 4, I need a company that's growing that free cash flow. Now, what is free cash flow? Cash generated from running the business minus the capital expenditure. So this is basically saying the cash from the business minus the required reinvestment that they need back into the business. Once they put their money that they have to put back in the business to continue what's left over, that's the free cash flow. And this money is important because this is the pot of money that they're going to pay a dividend, make acquisitions, pay down debt, and buy back shares. This is the most important number when you're looking at a business to invest, the free cash flow number. So I want a business that's growing this free cash flow. If I want you to pay me a dividend and grow that dividend, I want the pot of money that you're paying that dividend out of to grow as well. So it just makes sense. Growing their free cash flow. And number 5, I want a company with a lower payout ratio. Now, ideally, but before I say that, when I say payout ratio, what I do, I look at total dividends paid and divide that by the free cash flow. I go straight to the balance sheet, and I'm not really looking at dividends per share. I'm looking at the total amount that the company is paying out in dividends and divide that number by free cash flow. Now, some people look at dividends per share and divide that by earnings per share, which is fine to get their payout ratio. But me, I like to look at the free cash flow and use this metric or come out with the payout ratio this way. With that said, ideally, I want a company under 30%. Less than 30% of their free cash flow is being paid out in a dividend. If a company is growing that free cash flow at a high rate, and it's likely they'll continue to do so, then less than 50% may be acceptable, depending on the business. So 30% is that sweet spot. If it's less than 50, is higher. If it's higher than 30, but less than 50, it could be still a great candidate depending on the situation. So these are the 5 things that I look for when I'm looking for a dividend grower. Now, with that said, what I'm going to do is go over my 5 picks for dividend growth. So number 1, United Health. Now, this company is popular more recently because Warren Buffett's Berkshire Hathaway invested in it over this past quarter. I did a video on United Health in June, beginning of June, letting you know that this company, 1, is a great dividend candidate, also was greatly undervalued. I can't remember the exact fair value that I came out with, but this stock is still undervalued in my opinion. Now, for the purposes of this video, we're looking at dividends. So right now, a 2.7% dividend yield, if you were to buy this stock right now, 36% payout ratio. So pretty close to that sweet spot. Not quite below 30%, but pretty close. Also, over the past 3 years, they've been growing that dividend at about 12.6% per year. Over the past 10 years, 18.8%. So this meets many of our metrics just looking at this right now and looking at the trends. As you see, very strong growth trend over the past 10 years of growing their dividend. Started off at about almost like 1.8 billion, now paying over $7 billion a year in dividends. This is, again, a great candidate for dividend growth. Not only are they growing it at a strong rate, they have a lot of runway here with 36%. Now, let's go to the second one. The second one that I like, Visa. Right now, if you were to buy this stock at $350, you're getting only a 0.67% dividend yield. Many people wouldn't invest in a company with this low of a yield if you're thinking about dividends. But remember, we're focused on dividend growth, not dividend income. So what if the yield is 0.67%? Look at how much runway they have to go, 23%, and let's look at the dividend growth rates for the past 3 to 10 years. 14% over the past 3 years, 15.5% over the past 10 years. So slowing down a little bit, However, as we see, very strong growth trend. They grow it every year. This year looks like a minimal growth between 20 and 21, but nonetheless, the trend is very strong. And as you see, we have a lot of runway. We have a great, strong company, mature business, and growing free cash flow. And as you see, we have evidence that they are interested in growing that dividend well above the average. So Visa is a great candidate for dividend growth. Let's look at our next one. Lowe's. Lowe's is also another great one. Now look, 1.8% dividend yield over the past 12 months, 41% payout ratio. So above that 30, not quite above that 50, but right in the middle of our range. Look at the past 3 years, 14%, past 10 years, 13. So a little bit of an acceleration over the past few years. But again, strong, solid trend, very dependable. 1 year with minimal growth compared to the other years from 20 to 21. That's COVID year, so that makes sense coming out of COVID, but continuing to grow, and that is a good candidate. So we have United Health, Visa, and Lowe's. Let's look at the next one. Intuit. A lot of people say if you invest in dividend growth stocks, you're not going to have a lot of tech stocks in your portfolio. I say they don't know what they're talking about. They don't know how to invest. They definitely can't research like I can. So this is, which is simple research. I'm not going to sit here and act like I'm using rocket science to find these businesses. However, $661 for the stock price, 0.6% dividend yield right now, so not very high, 22% payout ratio, a ton of runway to continue to grow that dividend. Now let's look dividend growth, 17 and 16.9, pretty high, higher than the ones we looked at so far. So 17%, imagine you getting a 17% raise at your job. Most of us don't get that unless we get some type of promotion. But however, think about having enough invested in this company where it pays for your bills and is growing at 17%. That's the type of retirement that a lot of us aspire to have, where not only we have income, but we have growing income. And dividends is going to be your best bet for that, in my opinion. So we look at this strong trend again, 20 to 21, pretty decent, not as minimal as the others, but every year, strong, dependable dividend every year. So let's look at our last one. This is one of my favorite stocks that I've owned since 2018. Dick's Sporting Goods. This is a sleeper for a lot of people. Now, we're going to go to these averages in a minute, but I want you to look at this stock. $209, 2% dividend yield, 2.2%, better than some of the others, 37% payout ratio. So a little bit higher than our sweet spot, but definitely within our striking range, below 50%. Now, these ranges are a little off because of this crazy dividend year in 2022. Now, why would a company do this? Now, as you see, even without this, they have a strong trend that's accelerating over the last 2 years, okay? In 2022, they paid a special dividend of about $5. I think it was a little bit over $5, maybe $5.50 per share. So this is why in 2022, they had this $600 million dividend where they went from just 100 million to 600 million down to about 1.6. Now we're over about almost 3.5 million in dividends being paid per year. So a special dividend in this year. So companies who are paying a special dividend, again, think about these companies that I explained to you. Each of these companies, Intuit, United Health, Lowe's, Visa, Dick's Sporting Goods, they have a singular focus. These are not highly acquisitive businesses taking cash flow and buying company after company. That's typically not what they do. Now, Intuit does acquire some businesses, so I will admit that. They do acquire a good number of businesses. These are typically smaller acquisitions to help build out their current customer base and the current products that they provide to their customers. However, most of these companies have a singular focus, payout ratios that give them a lot of runway, strong dividend growth over the past 3 to 10 years. And these are all strong, noticeable companies. These aren't companies that you never heard of. These aren't businesses that you have to do a ton of digging to find. These are businesses that we see every day or we use every day, many of us, and they are growing their dividend at a great rate. So a lot of these boring businesses are the ones that are going to do this because they're strong, they have a competitive advantage, they're mature, and these are the ones that we want to look at when it comes to dividend growth. So these are the 5 that I chose that are kind of like my top 5 right now. One, Dick's Sporting Goods, I'm invested in. United Health, that's one that I'm strongly considering investing in. Since I've been considering since June, so that's another one. I don't own Visa and the other ones. Lowe's is one that's been on my radar as well. So just giving you an idea of my experience with these stocks and how long I've been watching them. I've owned Dick's Sporting Goods since 2018. It's been my favorite dividend grower. They've grown their dividend every year since I've owned it, as you see. Twice they've grown their dividends twice in the single year since I've owned it. And then, of course, I've benefited from the $5.50 in 2022. I've reinvested all of those dividends. So, yes, Dick's Sporting Goods is one of my favorites, one of my sleeper stocks for that purpose. Definitely one that's going to be paying my bills in the future when I get into the retirement zone. So let me know what you think about these 5 stocks in the comments, and I hope to see you in the next video.